The new Republican tax bill is already affecting real estate investing. Here's how. That's today's episode. Let's dive into it. Hey, freedom fighters, welcome into the Investing in Real Estate show. This is the show where we want to help you build passive income and create financial freedom for you and your family. It's the number one way to build wealth. And I've been investing in real estate for a long time, and I've rehabbed thousands of homes. My wife and I hold many properties, and buy and hold real estate is the vehicle that we use to create financial freedom. I believe it's the number one way to create wealth in this country. And of course, with the new Republican tax bill that just went through Congress and is now officially law, let's stop even calling it a bill anymore. It is now official. It is the law of the land in this country. And it's already affecting real estate investing. And we're already starting to see some of the numbers. You know that here on the show, we like to keep current and give you the latest market news as it relates to your investments, where you're going to put your money, and how it's affecting things more broadly. So you got to look at these trends. You got to be smart about this stuff. If you want financial education, you have to pay attention to this stuff. You have to be smart. You can't bury your head in the sand. And I don't mean you have to sit there and watch the nightly news every night, which is often skewed and which is often not talking about actual real estate investing. It's talking about the retail buyer, the person that's buying a flip property with their two kids and they're going to live in it for 5 to 10 years. That's not what I'm talking about. We're talking about real estate investing. So where and what states would you put your money? What types of properties? If you've listened to this show for a long time, if you've watched any of the videos on our YouTube channel, then you know we invest in C and B neighborhoods. Those areas, those blue-collar, upwardly trending neighborhoods that have blue-collar employees, workers that are going to live in those properties. They aren't going to lose their jobs in an economic downturn. They tend to work at the local hospitals. They work at the post office. They work at the local factories. They work at the Amazon distribution center, the FedEx distribution hub, UPS, those places that are American-based jobs that aren't going to China. That's our bread and butter, right? That's what we talk about here on the show, that even in economic downturns, these neighborhoods historically have remained constant. They're renting for $800 a month. You're paying $50,000 for the property, all in. That's after you include the rehab, and those stay consistently cash flowing. What are you going to drop the rent to $750 or $750 down to $725? No, they're going to stay consistent. It's the A-class neighborhoods, the ones that you're paying $4,000 a month for, that are going to get hurt in a downward economy. And we're seeing this already in the Republican tax bill, which is now law. If you remember, in 2017, as this law was unfolding, I said right here on the show that indicators were that we could see some big problems in higher-priced A-class neighborhoods, specifically A-class states, blue states, like New York, like California, like Miami and areas of Florida, New Jersey, Chicago, San Francisco, those higher-priced areas. And guess what? According to the Wall Street Journal this morning, according to CNBC, we're already seeing this data unfolding. And what's happening in Manhattan? We actually saw a pullback in the fourth quarter. In Manhattan, in some of these higher-priced neighborhoods, we saw a sales volume drop of 12%. Why? Well, according to Douglas Elliman Real Estate and Miller Samuel, the appraisal firm in New York, they said it was specifically because buyers were worried about the new GOP tax bill. So these prices, these properties that were over $2 million that people were buying, they stopped buying them. It slowed up quite a bit. And why? Because the bill stopped allowing in these blue states the deduction of state and local income taxes. So those state and local income taxes, the deductibility of the state and local taxes, is going to add a huge amount of pressure to these higher priced areas. So New York and California, etc. And what did we see? What did we say was going to happen? We said that, and there was a number of reports that came out because of the GOP tax plan, that this is going to encourage investment and growth in other states where the state and local taxes are not as high. In some cases, certain states that don't even have income tax at all, right? Like Texas and other places in Florida, where property taxes are low. Because in New York, you have very high property taxes. So do you do in New Jersey. So do you do in California. And what happens is then the cap is at $10,000. So anything above that, you're not going to be able to deduct. Doesn't make any sense. Therefore, does it make sense as an investor to put your money into Manhattan Or does it make sense to go into other areas of the Midwest where there's a lot of growth and where the taxes are way lower and encouraging investing? So I said right here on this show, if you are investing in those, middle America spots, this is good news. This is good news because we are going to see a pinch in those A-class neighborhoods. And I even put this out on Facebook at one point because it even highlighted some of the counties. The one county that I used to live in New Jersey, Essex County, New Jersey, one of the most expensive counties in the country. So they're about to see some prices dropping big time in these counties. I mean, you couldn't even, houses there, we didn't even keep inventory because they were selling so stinking fast. Guess what? Instead of selling for $1 million, it's going to start selling for 800 and 700,000 because of the lack of state and local income tax deductibility under this new tax law. And guess what? We're already seeing a move because in a separate article in the same morning, we saw some of these abandoned factory buildings downtown in parts of Indiana and Michigan. There are already companies saying we're buying them. We're going to buy them and start to put in some higher priced condos, some A-class condos. Now, I don't invest in those types of properties, but what that does is that's great for the tax base, right? That means more jobs, more people coming into that area, and it helps the areas that I do invest in those C and B neighborhoods grow as well. So we already saw there's an abandoned GE building in one part of Indiana that is now about to be turned into to luxury condos. That's because it was sitting vacant. It's huge. I think it's like 39 acres, the size of this complex. And that, instead of investing in New York City, investors decided, we're going to buy this big thing up and we're going to remodel it and we're going to turn it into some hip, trendy condos for investors. And I think that's a great move. So here again is what we're seeing some of the signs. I want to go through some more of what's happening in this CNBC piece to give you some more data on this. The high end of the Manhattan market right now is showing some of the biggest cracks. The inventory of these luxury apartments that I've been talking about right here on the show, those in the top percent by price, grew by about 15%. And now there's a 17-month supply of these luxury apartments in Manhattan, and that's up from about 10 months a year ago. So now with all these new condo towers that are sprouting up all over Brooklyn and Manhattan, those numbers are likely to grow where they're just going to be sitting there. And they're not going to be able to demand the rent prices that they were able to once before because people aren't going to buy them as investments. They're not going to pay $2 million for these things anymore because now they will not be able to deduct the state and local taxes, and therefore it's not as much of a tax shelter as it once was. Remember, I always say the tax code is written to benefit you as an entrepreneur, as an investor. But there is the problem and the big caveat if you live in one of these blue states that have very high property taxes. So again, as an investor, you need to be smart about where you're putting your money. They also said in this piece that resales, as opposed to new development, are holding up strong. So not a lot of new construction right now. So resale properties and the median sales price is up by 2% over last year. That's a good number. So without all this new construction, the resale value has been holding strong as well. And the number of new developments is expected to continue to rise this year and next, which is going to add to this inventory. Now, this isn't something where these people are just starting the new construction right now. They've already been in permitting. They've been planning. This has been going on for 3 years before they've actually broken ground on some of these projects. If they had to do it all over again, you have to imagine that they would have put the brakes on these projects in these areas. A lot of them would. We saw that this is what happened in Miami before the crash. This is what happened in San Francisco. This is what happened in Nashville. This is what happened in a lot of areas. This rush to build, and then suddenly, boom, recession hits, and now all of these high-priced buildings, these condos that they were going to sell for $1 million a pop, guess what? They had to turn them into apartments and rent them instead. So here we are starting to see the effects of this tax bill before it even became a law. And now that it's law, we're going to be watching this very closely over the course of this year. What will this mean for you as an investor in some of those middle markets in this country, those lower priced areas that are catering to those blue collar workers, those blue collar renters? That's what we go after because to me, that's the safest, smartest, and longest play in real estate investing. I would love to know your thoughts about it. And if you're already seeing that in your neck of the woods, and are you starting to see some of the pinch where you live? Let me know in the comment threads on this video if you're watching the video. And if you're listening to the audio, please, I'd love to hear. I'm on Twitter at Clayton Morris. You can reach out to me there as well. We publish this show multiple times a week, and we always try to stay on top of the trends. If you are ready to dive into real estate investing and you're ready to pick up your first rental property, that's what we do. That's what my company does at Morris Invest. So just come on over, book a call with our team. The link is right below. You can click on that and book a call with our team. We'll jump on the phone with you for 30 minutes and get a sense of what your goals are for your life. How much financial freedom would you like to create? What is your freedom number? Do you need to hit $4,000 a month in passive income? Is it $5,000? Let us know and we'll work with you to make it happen. That's what we do all day long. Thank you guys so much. Now just go out there, take action, become a real estate investor. It's the #1 way to build wealth. And we'll see you back here on the next episode of the Investing in Real Estate podcast. Have a great one, everyone.